lots of global risks now, and we've seen the Fed play out pretty much according to the script. The anticipation is that if the Fed were to start tightening, it would happen only in the third quarter of 2015. The ECB and the fact that perhaps we could see that stimulus coming in there from the ECB driving global liquidity, and that would perhaps send our markets higher. What are you factoring in as far as global factors are concerned?
Well, my limited perspective on this is as follows, which is that a lot of people are talking about the potential for rates to rise here in the US. But the point is, it is being, articulated now, right? So like the taper, we had an initial hiccup in the markets in May last year. But eventually when the taper happened, and then it happened every month.
And now we don't care.
So likewise, I think given that the rate rise is being talked about today, it probably will happen middle of next year. I think that is enough time for markets to adjust. And so I do not see that as a big dampener to equity market sentiment at that point in time when it happens. So that's the first point. On the other hand, if there is further QE effectively in Europe or in Japan or elsewhere, then that's an added tailwind to equities, especially in emerging markets. So on balance, if you put both together, I'm actually quite bullish. Once you have the growth coming through, earnings growth coming through, I don't think either of them, and certainly the rate rise is, to my mind, not as big as a risk as is being made out to be among some commentators in the market. And the bigger risk, though, I think is geopolitical risk. So that is something which the markets will have to deal with as and when there is a geopolitical issue. But absent that, I think as growth comes through, I think equity markets will reflect that quite amply in terms of the uptrend.
Would you agree, Sunil, that
I'll just like to add here, if you go into history, the period of rate increases in the US has coincided with Indian markets doing the best in terms of equity. So you can, you can correlate that. Logically, if rates go up, the risk aversion would reduce and emerging markets should come down. But the best returns in India were made between 2003 to 2007, which was the period where US tightened the most. So you just can't correlate that just because there's going to be a small increase in interest rates in the US, we will have a reaction. At least the past historical evidence does not
corroborate that. And the possibility of a QE and what that could mean in giving us that additional tailwind that Nag was just talking about?
See, I think from our perspective, what we are seeing is that emerging markets generally as a class is now reducing, is losing as much relevance as it was earlier. Because some countries are doing well, some countries are not doing well.
So you can't club them all together?
Yeah, and that is where India is now starting to score. So the allocation to India, even within the emerging market basket, is increasing, because here you have a country where despite everything has managed to be quite stable. We're still growing at 5.5%. We are a country where the interest rate reduction cycle has not even started. Which is among the very, very few large economies in the world where we have that luxury. So I think once that starts, there's going to be increasing flows and also increasing profitability, because a big chunk of the operating profits of Indian corporates are being eaten away by interest costs because of the high interest rates. So I think things can pan out to be much better than what we are anticipating.
Things will pan out to be a lot better. It will also depend on what this government actually does in terms of tangible action. You were fairly bullish when this government came to power that they will move on crucial reforms. We haven't really seen the reform agenda moving forward. There's a lot of intent out there, but tangible action is yet to translate into reality. What are the questions that investors are asking you about policy decisions, and how much of their finally committing money to India is incumbent on the government acting on those promises?
See, I think, if you ask the marketplace, what are your expectations? Expectations will always be outsized. So I think we should also, when we talk about reforms, it cannot be headline grabbing, big reforms every day. I think if you do the small things which make it easier to do business, alongside some of the bigger policy issues, I think that is good enough to keep investors happy that there is progress. There are, of course, expectations that in the next 6 months, especially leading into the budget in February, that there will be further announcements on the policy front. And I think those expectations are also, reasonably realistic on the part of investors. So they are taking a 3-year view, a 5-year view, at least the large institutional investors. They're not necessarily taking a 6-month or a 12-month view. So I think it's a fairly measured expectation that I sense amongst institutional investors about the pace of reform.
Would you agree?
So I think what has happened, Shereen, is obviously when this new government came into power, there was a lot of talk. And the talk raised expectations. So there was an expectation and the talk raised expectations. And there's, at least from our perspective, there has been, you can say, some anxiety starting to creep up. In terms of some action.
So there is?
There is definitely. It's a small anxiety, and I think the next 3 months are going to be crucial. So, people understand that there are a couple of state elections coming up, and maybe, give them a couple of months more. But I think something has to be done now in the next 3 months. And I'm not talking about big reforms like labor reforms and all.
What is it that you would like to see happen over the next 3 months?
So I think, from our perspective, like this coal issue, yes, it was not the government's issue, but the Supreme Court's issue. But at least the government can now take the lead and sort it out the way they sorted out the spectrum issue a couple of years back. So I think those kind of things definitely can, again, sort of increase the confidence, And what we are seeing is now, people are bullish on India, but they are holding back their fresh investment. That let us now see.
I have a nice divergence here on my panel. You don't see this holding back or sitting on the fence just yet, but Sunil is clearly sensing that.
No, well, not because of reforms or the lack of it. It's because the market ran up too fast. So I think this correction, to my mind, is an excellent opportunity for those investors to come in and start buying, but not because they haven't seen any great reform. I think they are quite realistic about their expectations, and like I said, the February budget will be one that they will look forward to in terms of a lot more policy announcements.
You don't agree?
No. See, frankly, we are very positive, and we believe that this government has shown the intent, and they have the capability of taking India much further. What we are basically saying is that the expectations were raised so much that now there is a little bit of anxiety.
Which are the sectors that you see being punished the most? Which are the sectors that you believe, or stocks in specific, that are looking most vulnerable given the current context?
So I think if you see, the metal pack has just been butchered because of what has happened on the coal front. But again, the move towards quality is again started. So, post-May, you had all infrastructure companies, irrespective of their balance sheets, move up. We have seen most of those companies now trading much below the pre-election rates. So wherever there is a stress on balance sheet, investors are realizing, and that is a sector which is clearly avoidable.
Now, what are you going to avoid in the market?
No, I don't think there's any question of avoiding any sector, because I do believe that with growth reviving, I'm sure that many sectors will begin to do well, some sooner, some later. So I don't think there's any such thing as avoiding a sector. It's a question of relative return potential that will guide our portfolio construction. Well, like I said, I like banks, I like financial services companies, and like Sunil mentioned, in the infrastructure space, so long as there is not much financial stress on the balance sheet, I think some interesting companies there with good fundamentals can be considered. Technology and pharma, it certainly has good growth potential. And of course, autos, energy, power sector, so there's enough choice. But I would principally look at financial services and banks as a key weight in a diversified portfolio.
We're talking about the road ahead, and the government has lined up this ambitious disinvestment program. They're starting off with SAIL. We don't know whether they will finally go through with it or not, given the fact that we've actually seen the stock correcting very, very sharply. But do you believe that there'll be enough takers for the government paper, given the regulatory overhang and the uncertainty, for instance, around ONGC with gas pricing now being deferred to November, Coal India with its whole coal business? Do you think there'll be enough appetite?
I think so.
Irrespective of all of this?
Well, again, investors will take a 3 to 5 year view, and we've seen this in the past. When there were large offerings and people wondered whether the marketplace would be able to absorb it, it happened. So I have no reason to believe it will not happen again. People will buy, and the issues will happen, and will be successful.
Sunil, you agree?
See, actually, there are many new large investors who are wanting to enter India. And from their perspective, I think execution becomes very, very important. So I think we have seen in the past, and I agree with Naganath, earlier also it has happened that large issues bring in more large investors into the country. So some of these issues, if priced reasonably and where the fundamentals are at least clear, there's definitely going to be massive interest.
Corporate India has been on a fundraising drive, partly to sort of, repair balance sheets, to deleverage. Do you anticipate that continuing?
That always happens, So there are definitely corporates who are waiting for this opportunity to raise capital to repair some of the stress. There are some corporates who are waiting for this opportunity to raise growth capital, specifically on the financial side. So if the view is that the economy is again going to be chugging along at 7-8%, credit growth will be upwards of 15-17%, and all banks would need capital. So I think there is one category of companies which are raising capital to repair their balance sheets, and there's another category which is raising capital for growth. I think from an investor's perspective, both would be interesting, depending on what is the size of the capital being raised and whether it is enough to either fuel the growth or to repair the balance sheets.
From a macro point of view, what do you see as being the big downside risk?
Well, the downside risk to my mind, like I said, is geopolitics. If that causes a sudden reversal in the decline in oil prices that we've seen, although that spike in oil prices, should something happen on the geopolitical front, will be short-lived. It could create a bit of a dampener in sentiment temporarily. But what I've also noticed is that if it were to happen, the subsequent decline in oil prices is even steeper and then more sustainable. So the trend, I think, in oil prices, from what we hear from the experts in that sector, is that it is probably heading further lower. And therefore, if I take that view over a 3 to 5 year perspective, I think, it's good news for our country.
So year-end target for the markets?
I would say I still maintain that in 3 years,
the Nifty will double, but year-end.
She didn't say which year.
I know. Who knows about 3 years down the line?
Which year? This year. Okay.
End of this year.
I think after a 5 to 10% correction, I would not say this year, but say by the end of the financial year, March, I think the markets could rise 20 to 25% in my opinion. After the mild correction of 5-10%.
5 to 10%, 20 to 25% by
March, April.
March, April. Sunil?
I think we are not in this target thing, but we remain optimistic. And from our perspective, Shereen, we believe that India has the potential of being a $4 to $5 trillion economy in the next 6-7 years. And that is what the market cap of India would be to be the least. And I think on a tax-adjusted basis, this is the only now tax-free sort of investment which is available. So it's I think things are good. Achhe din hai. Invest.
So you're not sweating the small stuff at this point in time?
No, I think if the funds are up 60-70%, if you lose 5%, you're still up 55%. I don't think anyone would be complaining about that.
Well, it's good to hear that. Nag and Sunil, appreciate you joining us here in New York with your take on where the markets are headed and what investors are talking to you about with regards to the India story. It's always a pleasure speaking with the two of you.
Thank you.